Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? All is good out there? Well, one of the perks of having, and I'm not saying this to be braggadocious or anything, but one of the perks of having a lot of clients here that we work with is you get a feel for things, right? You get a feel for when people are starting to get nervous, right? You get 40 emails or whatever. So you get a feel for when people think the stock market's bottomed out. Maybe this is our chance, right? I love that, right? And again, it's a great data set to use. But there's a bit of a problem, and this will be a short one, but I'm finding that people are saying inflation. Oh my God, I'm scared of inflation. What do I do about inflation? I've got to do something with my dollars in my bank because the best high yield interest that you can get right now, I think, is 1.25%, 1.5%. I don't have somewhere to put this money. It's my emergency fund. It's an inheritance or something that someone wanted me to buy a house with in the future. But boy, this inflation, 9%, it's going to get eaten away. Think about this for a second. If inflation were that detrimental to a dollar in the short term, right? Because that's kind of what you're talking about here. Don't you think the banks would adjust? Don't you think that when they gave you a car loan for what is now, 4 or 5%, something like that, don't you think they would adjust and say, wait a minute? Because think about what they're doing. They're locking in a loan for you for no more than 48 months, right? You know the drill. And they're saying, go ahead and pay us back. They know they're losing 9% on every dollar that you give them back. Granted, some of it is interest and they're making 5% or whatever they charge you. So they're losing money, right? Technically, right? But if they really were worried about it, then your rate would be above inflation, right? Same with a mortgage. Okay, rates went up, great. Mortgages are now, 5.25%, depending on whatever you're getting out there. That's 30 years. Maybe it's 15 years and you got a 4.9 rate or something like that. Don't you think the mortgage companies would be like, well, wait a minute. Inflation's over here. That dollar that you're paying back every single month is losing to inflation, right? So it's called not juking when everybody else is jiving or whatever. Yeah, it's a kid's old saying there. Not overdoing it because you have a fear of inflation. And I tell you, the biggest risk that people take, and I'm watching them do right now, I have to talk them out of it, is they go, I can't beat this inflation with any standard low or no risk product. And so therefore, or investment. And so therefore, I'm going to invest in the stock market. Yeah, hey, stock market averages returns that are like that. Sure, I'll do that. No, don't do that. Don't let inflation force you into taking risk. You can let inflation force you to ask questions. Maybe start poking around, take a more detailed look at your dollars and figure out, can I weather this? Would I rather have the cash? Is there something I can invest in? Is there something that I want to spend the money on, right? Okay, that's fine. But don't let it force you into the stock market. That's the weirdest thing for a financial advisor to say, because my job is to get you to open accounts with us and fund it. And then hopefully I do really well with you. You get the gist of it. I don't try to hide what we do here, right? So I'm supposed to tell you, inflation, invest in the stock market. That's a big mistake, because now you went from taking no risk to, well, you see what's going on in the stock market. One day up 2%, one day down 2%. We had a 6% over 6-day gain in the stock market. We're averaging 1% up on a day, and then it gets taken away. Don't do that with your savings. Hey, I'm going to buy a house in 6 months. Hey, my car's going broke, and as soon as it dies, I'm going to buy a new car. Don't do it. Hang on to it. You will not sit around losing year after year after year on those dollars. It will be better off that you had those in your pocket. Now, you can have high interest savings. You could maybe even use some CDs these days. You can mix and match. There's people that jump around from different high interest savings accounts to others. All right, as detailed as you want to get about it, have at it. Just don't go in the stock market. And if you do, like for us, we put together something we call the low volatility fund, where for every position that goes down, a position goes up as well. It's not perfect, but that's the goal, right? But the total yield is over 3.5%. Okay, so we're not really taking risk in the form of the S&P and hoping for gains. So that one's kind of okay. If you could do the same thing or find like a money market fund, something that makes you happy, okay. I'm talking about investing in the NASDAQ, the S&P. Oh my God, look at Tesla. Let me go for it. Don't do that, right? It will prove to be a mistake. And if you made it that far, thank you for listening. I know this was more of a rant today, but it's kind of like an update on what people are thinking and asking. And I just want to point it out because you're probably thinking or feeling the same thing. Don't do it. Hey, you made it to the end. That's awesome. Well, if you want to check out more geeky stuff, be sure to check out that video over there. Also, if you could subscribe, that really help us out. We're financial advisors that love to teach, and you'll find all kinds of free stuff on our videos. And remember, keep your dough straight. Yeah, I did it. You did. That was it.